good afternoon, or good morning, depending on the time zone you might be dialing in from today. Welcome back to another session here at Lendit Fintech. My name is Todd Anderson, Chief Product Officer at Lendit Fintech. So today we're talking about trust and trust as a must for fintechs. Before I turn it over to my esteemed panel for introductions, just a few announcements. First, we did have an additional panelist, Sergio of Creditas in Brazil. Sergio wasn't able to make it, so we wish Sergio well, and I'm sure you'll see him back here at some point in the near future. Secondly, to the audience, thanks again for joining us. We encourage questions, so at any point during the conversation, go ahead and throw a question in the Q&A box. We'll get to those questions as we move through the conversation. So don't be shy. If you have something on your mind, 5 minutes, 10 minutes, 20 minutes in, just go ahead and throw it in the Q&A box and we'll be sure to get to those. And third, I want to thank the team at Zendesk. Kristin, the team, Tommy, everyone at Zendesk. They've been big supporters of Lendit for a while now. Without support like theirs, we can't do not only webinars like this, but all the other events that we do as well. So we greatly appreciate the support and thank you. And so first, I will start with Kristin of Zendesk. Kristin, introduce yourself to the audience and tell them a little bit about yourself.
Sure. Thanks, Todd. And thanks to you and the whole team there at Lendit for all of your partnership. For me personally, financial services and fintech is something that's near and dear to my heart. Before I joined Zendesk, I worked at a commercial bank and was helping venture capital private equity funds as well as their portfolio companies with their commercial banking needs. About 5 years ago, I moved to Zendesk, which is we're a software company. We build tools to help startups and large enterprises, so companies of all size, take care of their customers better by providing best-in-class customer support. And so I'm really excited about the conversation we're going to have today. For us and in the business that we're in, trust is the thing that we try to promote and develop by these interactions that we have with customers. We try to enable that. So I'm really pleased to be here today and having the chance to sit with you and the panel to talk through that concept as well as some of what we released in the white paper.
All right, sounds good. Dan, we'll go to you next.
Thank you, Todd, for inviting me. My name is Dan Tran. I'm a co-founder and general partner of Navcal Ventures. We're a new venture fund we just set up earlier this year, and we're investing in fintechs and insurtech. Previously, I was a senior advisor at the CFPB, and I was heading the CFPB's fintech office back in the days. It was called Project Catalyst. That's how I got to meet with a lot of fintech CEOs, founders, and listening to their exciting stories and working with them to help them remove regulatory uncertainties. So I've got a lot of experience in regulations and compliance. And now I'm a big investor, so I'm also, really understanding fintechs from the other side of this equation. And trust obviously is a very important issue, both for a regulator and for an investor.
All right, thanks, Dan. And Michael, we'll go to you next.
Thank you, Todd. Thanks again for the invite. Super excited to be here. My name is Michael Rangel, founder and CEO of Novo. Novo is a challenger bank focused on the small business segment in the US, but more specifically, very, very small businesses. Very small businesses spread across all 50 states, even some US territories, which is kind of interesting, spread across a very diverse spectrum of industry.
All right. So, I want to kick off really with the question of, are fintechs held to a different standard of trust than, say, traditional financial institutions? And, really, I think especially in financial services, when people are handling your money or helping you to handle your money, the object of trust is huge. And we've seen lots of different issues with banks in the past, but it still feels like while fintech is growing and the ecosystem is evolving, that they're held to a different or higher standard than, say, traditional banks. Is that true? And so first, Michael, I'll start with you, and then we'll go around to Kristin and Dan as well. Are fintechs held to a higher standard of trust than, say, traditional banks?
So great question. I actually have almost like a slightly opposite view. I think that, I don't necessarily think that there's a different standard of trust, first off, necessarily. But I do think that when you're talking specifically about fintech and fintech adoption, fintech products, fintech service, et cetera, that there is a higher sense of flexibility, right, from the customer standpoint. There's a higher sense of flexibility, which is usually directly correlated to like a bad experience that customer may have gone through, whether that be with a larger incumbent at some point in their life, that they're willing to go through that and kind of like willing to go through the motions and those bumps along the way in order to afford them, kind of that better experience overall.
Kristin, I'll go to you next. As Zendesk works with a variety of different startups. Same question to you: are they held to a higher standard, different standard than, say, traditional banks? And I think you offer your unique perspective, being that you used to work with and at banks.
Yeah, I'll say, Todd, I think that our health and our money are kind of the two things that most of us are unwilling to compromise. So in that regard, traditional financial services companies and fintech companies both have a pretty high burden of trust to be met. I think for fintech companies, different from their traditional financial services counterparts, these companies are new. Oftentimes they're path breaking in the industry. And so the challenge that you have in terms of building trust in that environment is, you don't necessarily have the baggage that comes from being in market for a while and the ups and downs with working with your customers. But you do have the challenge that your brand is new and you have to establish yourself, and building trust when you are still relatively new in the market. It comes down to those day-to-day interactions that you're having with your users, just how responsive, just how transparent you are with them. And so, it's not exactly an apples to apples comparison, I would say. But regardless of where you are in the world of finance, expectations are high. And I think the other thing too that we see probably a little bit more so impacting fintechs than a traditional company is that consumer expectations are going up across the board, and those increasing expectations probably fall more highly on young, fresh, savvy companies than they do of older, more traditional brands. And so when we have fintech companies that are providing great experience, that only raises the bar for others to meet. Even if you're in a B2B world, your buyers are consumers in their personal lives, and they bring those expectations with them. So we see that kind of creeping in, and I think that we've all been a bit spoiled, right, in our lives as consumers. Great service from brands like Amazon, Uber, Airbnb. The changing of our expectations of consumers by those upstart challenger brands, let's say, has just risen the bar for everyone to meet, and I think that fintech companies do feel that even more so.
Dan, what about you? You've been a former regulator, now an investor. I think you have a lot of different areas to come at this from. But what do you think in terms of just the general notion that are fintechs held to a higher standard of trust, being that they're newer and haven't been around for, say, 150 years like a big bank?
Sure. Yeah, I do agree with Kristin on that. Money and health are the two things that consumers would never want to compromise. And I think the challenge for fintechs obviously is, at one hand, they don't have any baggages. On the other hand, they're new, and especially if I think my former life as a regulator, when we meet with the fintechs, we always expect them to really behave not just like a fintechs, a couple of guys wearing jeans, but they also, have this sort of the notion of responsibility for people's money entrusted in their hands, and responsibilities for complying with various huge number of rules and laws that ensure consumers are protected. So I think in that sense, I think fintechs definitely are held to maybe a bit fairly a higher standard, at least from the regulators' perspective. Now, if we talk about the the direct to consumer models, I do think consumers view them no different from Wells Fargo, Bank of America, or Chase, because it is their money. Whether the debit card bears the name of some de novo name, right, or Chase, at the end of the day, it's the money that's sitting somewhere in an FDIC insured account, and consumers expect the money to be safe. And when they need to use the card will be there to help them complete the transaction. And I think in that regard, the trust, the expectation is the same. On the B2B side, I think it's very interesting. I dealt with a situation where a very large incumbent, not a financial institution, actually a very large company, Fortune, 100, probably even bigger than that. They had to, take the risk of working with two very small fintechs in order to enable a solution for their, for their clients. And they actually took a huge, a risk in working with these people. And for them, trust is everything, and the standard is extremely high. So they probably held these fintechs at a very, very high standard before they decided, we're going to pull the trigger and work with them, because if things go wrong, that company is actually is going to be on the hook to blame for the failures.
You've all mentioned various pieces, and my next question is kind of related to those various pieces. Is there's regulators, there's your end customer, there's investors. Is this concept of trust defined differently to each of those? How do you kind of gauge working with all these various parties and figuring out what level of either transparency or what level of information is needed to make sure that trust is built, and is it different depending on who you're ultimately talking with? Michael, I'll go to you on this as someone who is operating a fintech. How is it that with the multiple parties that you must deal with, and kind of building that trust with each of those?
Yeah, totally. So first off, it's interesting. I don't think you necessarily need to build, a different sense of trust, but there are different KPIs associated with how you build that trust with either respective party, right? So we'll start with end customers. End customers, right? They care that their money's safe and they can access their money, right? At least for Novo's point of view, right? I have $100 in my bank account. I should be able to make a transaction for $100, right? At the most basic, fundamental level, right? Mm-hmm. If that works, great. Check that box. Move, down the list. Customer feedback. Is customer feedback taken seriously? Do they actually see tangible structural improvements in whatever the technology, the way that people are engaging with customers, right? Is feedback being taken to heart, and is the fintech or bank, et cetera, iterating based upon that? And then lastly, just pushing the boundaries, right? And actually putting the customer first and creating value for that customer, right? Whether that be through different product offerings, different features, et cetera. And so that's how you would kind of build trust with that end customer. Now, consequently, building trust with an investor is similar, but it's also very different, right? Because all that stuff, right, that you were doing with the end customer might or might not be generating revenue for the startup, right? Which is largely what the investors want to see, right? Revenue is directly correlated with how, this product is resonating with customers. If I tell a customer that my single KPI to build trust with them is for me to generate revenue off them. They probably wouldn't like it as much. But for investors, right? So like that's how we think about it. So for investors, how do you generate that revenue to keep those customers coming back and build that product and that flywheel to ensure that this is kind of like a sustainable business for all parties? And then lastly, the regulators, we have less exposure with the regulators. We've been very proactive in our communications with regulators, both myself and my co-founder. We actually went to the OCC's Office of Innovation in New York City a few years back. And so we've always been, open and transparent with them. And I think that, Kristin brought up that word exactly, transparency. I think transparency is the key for a lot of trust for everyone, all parties involved, right? Investors, regulators, and end customers. And I think that is one thing that the fintech ecosystem, or at least, a lot of the players in it have on their side of the battlefield is, leading with transparency, which definitely resonates.
And I wanted to go to you next on this as a, former life regulator, now an investor. How do you view that multiple party and building trust with the various pieces? And ultimately, is there, in the case of, you as an investor, do companies sometimes feel that pressure to potentially, hit growth versus maybe putting in place, a perfect compliance system as a, hypothetical answer? Like, how do those types of, and is there a trade-off if a company is thinking, all right, growth target versus, doing this, a certain way?
Sure. Yeah. So as a former regulator, I would say, honesty probably is the first thing to build the trust. And transparency is important. I don't think you should be, I think you should be as transparent as you can. But full transparency doesn't mean full transparency, depending on how you define transparency. It doesn't mean you go to a regulator and tell them everything you do. You need to be strategic. When you walk into the room with the regulator, both parties expect, well, at least the regulators expect that you are actually trying to spin the wheel a little bit, trying to tell a good story about yourself. You're trying your best to be on the good side of the regulator. So that expectation is there. Nobody is, in delusion about that. But the key thing is really tell them honestly. So if you tell them this is what you're doing, this is what your plan, this is how you're gonna, this is how your customers are expected to use your product, and this is where you sort of stumbled in the past and you're trying to fix it. I think the key thing is really about being transparent and honest. And it takes a long time to build a reputation, to build a relationship with the regulator. It takes only one lie to destroy everything. And I've seen that with my own eyes. So see how companies really lost the credibility. Once you lost it, it is really hard for you to pick it up. And the other thing is just about honesty is don't exaggerate. A lot of fintechs, when they engage with regulators, they have a lot of complaints. Not necessarily about the competitors. That's really rare. I've rarely heard people bad mouthing about their competitors, but many times it's about certain regulations don't work for them, which is very common complaint. And frankly, in most cases, it's you should hire a lawyer to help you figure it out. And the other complaint is really about some kind of anti-competitive practices, not necessarily by their competitors, but by maybe more of a incumbent, the large financial institutions. And the regulators, if they're informed, in most cases they are, they know these things happen in the marketplace, but do not overplay these things, because if you do that, you're going to lose credibility with the regulator, and you're going to lose influence on them when you try to push them to change policies, to make policies that will be in your favor. And I've seen that too. When companies overplay that, that just backfired. So now, as an investor now, I do think there's this natural tension between making sure you're in compliance versus you're going to hit the gas and accelerate the growth. But I think these two things are not necessarily 100% in odds with each other, because at the end of the day, if you can scale up your operations so quickly, and inevitably certain fabrics will be broken, and so I've seen that in some of the very high growth fintech companies, when the growth is extremely high, all of a sudden the complaints, the call volume just increase accordingly, and they just didn't have enough resources to handle those kind of complaints, and all of a sudden things will just erupted in media, and you got unnecessary and unpleasant scrutiny from the lawmakers, from the regulators, and you want to really manage that really well. So I will say, definitely do not do bad things to your customers. If you do not want to sell this product to your grandmother, don't sell to your customers. And that's just basic. But the second thing is really, when you scale up, you need to make sure you have the infrastructure in place to handle any kind of problems, pains that are growing with the expansion of your business.
I'm going to say I couldn't agree more with Dan's point on that, right? Your ability not just to be transparent with all of these partners it's key, but also that responsiveness, right? And in many cases, your responsiveness to your customers directly translates to that trust building exercise that you have with regulators as well. As we as companies try to do right by our customers and can monitor that and set metrics against it and share it, that then kind of feeds the other side of this. So to Michael's earlier point, a lot of the motions are kind of similar, or the underpinnings of how you go about building trust. They carry across your customers, your investors, your regulators. But the devil's in the detail of the metrics that you put against it and how you, let's say, rationalize those metrics with one another. So, if an investor is pushing you for growth, we, as you said, we're not going to go to your customer and say, revenue is the thing that's driving my interaction with you. What you could say is, I want to do everything I can to retain and grow you as a customer, and that helps you and that helps me, and being more transparent, being more responsive helps to serve that end for everyone. But I think that the way that this manifests itself in your company and your approaches can vary, but the underlying pillars are actually quite similar in all of these trust building exercises.
Kristin, to stay with you, is there kind of a as Zendesk works with a lot of different companies, big and small, but is there kind of this point at which the fintech starts, all right, now we need to start building not only our product, but some of these processes and things in place? And, I know that Zendesk offers technology for solutions like this, but when do fintechs need to start thinking about that? Because, you go from two people, they have an idea, or a handful of people have an idea, they start building out this MVP, all right, proof of concept, and all of a sudden it starts to go from there. Is it from that idea stage they start putting in some of these processes in place? Talk a little bit about what you see with fintechs that you work with, and kind of where they start building some of this stuff in, and how technology can also help with that.
Sure. The demand for growth drives everything in the early stages. User acquisition, customer acquisition. This is the priority, right? Because there's nobody to support and service and create an experience for unless you have those folks coming to your platform. Because of the world in which fintechs operate, especially those that are dealing with consumers, the regulatory environment means that you can't wait nearly as long as, say, a direct-to-consumer eyewear company could, because you definitely have responsibilities both to those customers and to regulators that are unique and that come through this world. So, I think that very practically speaking, companies can make it a ways before they really have to start building robust process, putting, big systems in place. but the opportunity to get started early is there. And I think that what we encourage fintechs to think about, and those that are doing customer experience well, they see that those early investments can not only help them kind of meet a minimum expectation, but it really helps set the business up for growth. Every time a customer reaches out is an opportunity for you to build a relationship, for you to understand them better, for you to maybe even, look for those ways to not just solve an issue, but to upsell or cross-sell or find another way to do more with them going forward. And so implementing technology that lets you kind of build that customer record as early as possible in a unified place, in a place where you can analyze and improve process from there, it certainly helps. But the best advice is don't over-engineer it in the beginning. Get started with something, to at least meet a minimum standard that you think is necessary for your customers, and just start rolling from there.
And Michael, I'll go to you. I see you shaking your head. I'm sure you've gone through some of this in recent time. I'm curious to hear what you have to say.
Yeah, totally. So, I mean, I agree with a lot of this stuff that Kristin said, but then want to also reinforce kind of how she left it off. Because I'm obviously the one bringing kind of like the startup perspective to the panel. You definitely don't want to over-engineer anything, right? Like in the beginning, especially the founders, the early team, et cetera, you're doing a lot of things that don't scale. And there's a reason you're doing that, right? Because you're literally testing all the freaking time. What works, what doesn't work, right? And so you don't over-engineer it, because then you might over-engineer something that you might scrap in a month, in 6 months, et cetera, that you just invest a lot of your time and resources into. So you definitely want to do a lot of it yourself. Don't focus a lot of time or resources into it. But getting back to the question, right, is like, when does it start becoming more important for a fintech or a startup or whatever to, focus on building that trust? Or like, when does it start becoming like most relevant? Like when just like that light bulb going off, like, oh wow, I actually need to build trust. The thing that gets me kind of most comfortable is like when that person realizes that there's something to lose, right? And when they realize there's something to lose, at that point, it's almost like a force function, right? It's like, oh wow, I'm being held accountable now by my first outside investors, right? Like they invested money in my business. Like I need to make sure that I do right by them. Or it might be product market fit. I might have my first customers and holy crap, they trusted me. I need to make sure that I deliver on whatever that, value proposition might have been in order to do right by them. And same fits for the regulators too, right? Because you want to be operating within the bounds of, what's allowable. But that's where I would say, right? It's all about kind of realizing that there's something to lose and that you want to defend it and you want to guard it and you want to make sure that it's successful before kind of over-engineering anything too much on top of it.
Dan, I saw a question come in the Q&A from one of our audience members that says the history of fintechs is littered with examples of companies that skirted regulations. I don't know if I'd say littered, but there's certainly been some examples of it until they hit critical mass and then layered in traditional risk management infrastructure that allowed them to be a long-term player. What pieces of trust infrastructure should you put in place that will likely not inhibit the growth that fintech investors are demanding? And I think it's also, for all the examples you see, there's probably 10, 20, 30 times the amount of fintech companies out there that, are not succeeding, but not necessarily doing as implied there. So I think it's less that there's littered, but, how is that balance of, some of what Michael talked about, you're testing, and then pushing for scale and making sure that you're not doing it in a way that's going to get you in trouble at the same time.
Sure. Yeah. I think the asking for forgiveness later approach doesn't always work. Sometimes it can work, right? So I think my experience with some of the very successful fintech companies, I think the culture is really set by the founders, by the founding team. So they understand that as I mentioned earlier, the honesty, the transparency when you engage with the regulators. So nobody is perfect, right? So if you walk into any company, not just fintech, but even large bank, you will find something that's not perfect, or there's room for improvement. But without sort of the mindset of compliance in the first place, I think it's really hard for me to believe any fintech can be a successful fintech in the long term, because you're managing people's money. That's something, as Kristin said, you consumers do not want to compromise whatsoever. So, but it doesn't mean you have to have everything, all the answers in place on day one. It's a process, right? So when the operation is small, you have more ability to try new things, and you can afford to fail. But when you reach certain scale, I don't know what the number is. Again, it's a gradual process. Then you realize that you got to have a nice system in place. Again, it doesn't have to be perfect to deal with all sorts of things that as a responsible financial service provider that you need to deal with.
I mean, there's a difference between not being perfect and purposely skirting regulations, because there's things and process to put in place, and sometimes it's you're unsure, or you might not know. But Kristin, I'm curious, how in what ways does customer experience essentially can help contribute to a fintech success, and that feedback loop of building trust with those customers, and then as you scale, because clearly early on you might be able to have this really good one-on-one connection, but hundreds of thousands, millions of customers, you kind of lose that, or maybe you don't lose it depending on the technology you have. But how is that balance, and how fintechs use customer success and the tools to help build that trust with their ultimate end customer?
Yeah. I'll say, just to kind of maybe connect it to that conversation about skirting regulations, I think you were right to say, hopefully not littered, and in many cases, let's say that is not the intended behavior necessarily. Oftentimes, especially when we're dealing with new products and new services, one of the challenges when you're in fintech is that there may not be a robust regulatory sort of structure for the kinds of things you're doing. And in those cases, I think you certainly need to have open lines of communication with the regulators, with your investors. But in some ways, as long as you're serving your customers well and ensuring that their needs are being met, in some ways that could give you cover as you think about whether the things that you're doing are right and just and true in those cases. So kind of shifting a little bit to this question of, how do you scale it over time? How does the approach to, serving this customer necessarily need to change? In the earliest days, we see our customers, we even did it ourselves, our founders are on the front lines of talking to customers, one, to address challenges that they're having, whether those are challenges with the product or the service or the way the customer experience is created. You have to own that, so deeply in the earliest stages, in order to learn, in order to refine towards product market fit even better, and in order to make sure that you're creating something for the market on which you can grow. Now, as you kind of get out of those stages, as you have more customers, the names that you can remember, as you start seeing more complexity arise in the user base that you're servicing, the only way you're going to be able to do this is by implementing tools and processes that enable you to scale. Some of those help in kind of a reactive environment so that you can be more responsive to your customers. And in fintech in particular, I think it's really important to think about the way you do that in authenticated, let's say, highly contextual experiences, So what I mean by that is, you can't just be responding from a shared email inbox forever. You need to create a system where you have rules and automations and predetermined responses when certain issues come in. And you also need to make sure that your team has the information that is relevant to that user so that they can help them as quickly as possible and as accurately as possible and move them on their way. On the sort of empowerment side of the equation, which we also think about as something that adds up to trust, self-service is one of the things that we really encourage fintechs to invest in early on. Our data shows that the most successful among them do this, and that also helps you with scale. One, it provides transparency to the issues that your users are going to have, and it kind of it presents those answers to them earlier in an engagement cycle. But it also, like I said, helps you with scale. The more that your users are able to understand not just your product, but your terms and conditions and what they can expect from a servicing perspective. All of those, I think, really add up to a better experience that will give your users confidence in coming back again and again to work with you. Because on this front, like in so many places, it's the product experience. We see a lot of compression around the differentiation there. And it's really the service side of the equation where fintechs kind of make it or break it. And so building these systems, these processes in once you kind of get beyond, founding team scale, it's really important so that you not only know and serve your customers well, but so that you also drive the long-term growth of the business.
We had a question come in from one of our attendees, Patricia. And Michael, I'll ask you this. Do you have a metric that measures your level of trustworthiness with your customers and other stakeholders? If so, do you have a sense of the impact of such measures on other KPIs? Have you had incidents where trust needed to be repaired? And if so, how did you approach it? Kind of a bunch of questions within the larger question.
Totally. Great question or questions. Definitely digging deep. I like that. What you're really asking for here is almost like the magic metric. And I think that magic metric is largely what a lot of people associated to NPS. Right? Everyone thought that NPS was like the gold standard as like health with customers and like how they're generally taking away the product and trusting the product or not based upon whether they're going to refer that or not. And the real answer is there isn't just one metric, right? It's like a bunch of metrics based upon in different sectors of the organization that all kind of in combination will kind of dictate, hey, yes, your customers trust you. I think kind of like the most directly correlated metric to trust in a lot of ways is retention, right? Like, are your customers even sticking around with you to begin with, right? If your retention is, especially in fintech, like the average checking account, like at incumbents is multiple years of time people stick around there, right? So if you're a fintech that's just spinning up, and your retention numbers, are signaling the opposite of that. Like that's something to be concerned about because I wouldn't say that there is that trust factor. So like, that's one of the things that we definitely monitor very closely at Novo is just what is retention on a month-to-month basis. If so, do you have a sense of the impact of such measure on other KPIs? Well, sure. So retention is always going to impact all other KPIs, right? Because you just have more customers who are sticking around instead of having to kind of like refill that bucket with new customers and spending CAC. dollars in order to acquire new customers, then get them engaged and activated, et cetera. So definitely retaining a customer is less costly than kind of acquiring a new one, right? So it's all about building a good product, ensuring that those people trust you and your product and actually use your product, right? And in the end, if you build a great product that people trust, then hopefully, right, you build one that will actually net some sort of revenue to keep, yourself above water. Have you had incidents where trust needed to be repaired? And if so, how did you approach it? We haven't had that yet. Knock on wood. We've been lucky enough to avoid some of the limelight in fintech that might be associated with some of the other larger players to date. So we haven't had to quote unquote repair trust necessarily. One of the things that we did that was pretty interesting earlier in the year, however, was PPP round 2. PPP round 2 kind of like shed, definitely pulled open the curtain on the way that some other players were kind of facilitating PPP. And so we extended certain, PPP loans to our existing customer base, continuously trying to quote unquote build on that trust factor, right? And so we were able to do that, and we had, a bunch of new customers that signed up with us in recent months. Before that, we only extended to existing customers, that we literally changed their lives. People on the phone kind of crying, saying, we can't believe that bank XYZ, shut us out in the dark. And, you guys, a fintech startup, were the ones who kind of came to our savior. But yeah, so hope that helps.
I'll ask it to Dan. I'll ask it in a different way to you. Is there a fear or are some fintechs, and this from your investor hat, that this magic number or magic metric can throw a fintech off course, and how do you kind of advise potential investments you make to it's not always about maybe one specific metric, but each stakeholder needs to be taken individually and built trust in a way that makes sense for that stakeholder.
Yeah, so I'm not sure if I know there's a magic, number metric, but I do think there is one thing that for fintech to really keep an eye on, which is the customer complaints. So obviously you have the public database that the CFPB makes available to anyone. It's free, anyone can search, can look for, and you have also your internal metrics on your call volumes, or how many customers call in or text you or email you for issues. So if you see any sort of a uptick in those kind of complaints, I think that's really a warning sign that you need to make sure that you're not really system is not breaking. So I've seen some very high growth fintechs, they sort of put too much emphasis on growth, and they just ignore these sort of non-sexy backhand stuff that they hope they will just go away, but they won't. They just won't go away. Especially as we know, the CFPB is re-empowered, and those things are really sort of front center in their eyes, and they have publicly said many times that they look at the complaints volume to guide their policy making, their supervision activities, and their enforcement priorities. So I think for fintech, if you want to really win the trust, not just to your customers, but also the regulators and others, this is something that you need to really focus on and always keep an eye on very, very carefully.
Kristin, anything to add maybe on the coming back from incidents, anything to that maybe you've seen that have worked, to not necessarily to call anyone out, but just rebuilding trust and the idea of kind of coming back from something that might have been a mistake or something overlooked?
Yeah, I think that we when we talk with our customers, we think about trust is something that's either it's either added to or taken away from pretty much every interaction that you're having with your users. So there could be one big incident, let's say, that impacts a lot of people, which in those cases requires a very, I think, thoughtful, coordinated, fast response. But then you have, let's call them the complaints that come in every single day. So let's say on the every single day kinds of complaints, if you really want to get down into kind of the operating metrics, the weeds of the operating metrics on a customer support side of things, you need to be measuring the number of outreaches that you're getting, how quickly you respond to them, how long it takes to fully resolve an issue. And at the end of that, is the customer satisfied or not with the interaction they've had? So those are kind of the three key components to see if your support organization is operating as effectively as it should. Ideally, those things taken together bubble up and kind of create this business metric that Michael was talking about, which is your retention rate. But in a specific incident, in a specific kind of big challenging moment, let's say when a lot of customers are impacted, the things that we've seen companies do well, one is to reach out with transparency, as publicly as is fitting for the incident as possible, especially if it's something that's ongoing. You need to tell your users right away what's happening and how you're working to resolve that. Companies will do that, through their website, sometimes on Twitter, wherever you know that your customers are, most commonly, maybe in your application. That's one. And the other part is then kind of tracking the way that you resolve everyone's issues related to that incident over time. And so you have the ability to group everything together that comes from that moment, and track them to full resolution. And so there are some really basic ways that you can kind of tie all of these problems into one incident and measure against that specifically. But again, in these cases, I think that transparency and responsiveness are the two things to lean back on and to really prioritize in your response. And when something really goes bad, it's not just the problem of customer support to fix. It has to be an all hands on deck response by your company to make sure, if it's really severe, to make sure that something is handled right away.
We have some more questions that have come in here. Dan, I saw you click on this one, so I think I'll throw this one to you first. From one of our favorites who joins a lot of our sessions, Matt Gamzer. Doesn't trust depend more on what the fintech is doing? I need much less trust if the fintech is lending me money than I might if the fintech is holding my savings or investing my money. In Dan's example, don't I trust the debit card more, presumably because it says, I think he meant to say Cirrus Plus, etc., for the debit card more, and because it also says Visa, MC, Discover on it, in addition to whatever the financial institution brand might be.
Sure. Yeah. First of all, Matt, good to meet you or see you, even though I cannot see you. But great question. But I do think the expectation of the trust is the same. So if you're a direct-to-consumer fintech, obviously, whether it's savings or lending or investment, I think the expectation of the trust is the same. So use the example of Visa, MasterCard, or Plus, these logos on your card sort of implies there needs to be less trust. But I would disagree, because in order for you to have these logos on your card, you got to get the trust from these networks. So it's the fact that you can get these logos on your card, that means you have passed their due diligence. They think you're legit. You have an issuing bank that holds these deposits. So you already won their trust, and indirectly you have already won the trust of your customers. And in the B2B setting, obviously, if the consumer doesn't know you are actually enabling these services, but at the end of the day, it's your customer. Your customer is probably the other businesses, your partners. They need to actually trust you in order for you to either use their platforms or for them to work with you or to resell your product to individual consumers.
Another question here from Melody. This one's a wider industry question. How much trust fallout have you seen in the industry from the quote unquote Robin Hood effect, meaning when other fintechs are facing customer and regulatory scrutiny and or fines/lawsuits? Do others have to then work harder to repair the damage done?
So
Anyone can take that one.
I can try this question. So I was involved with, so this was from a number of years ago. Anyone remember the Rush Card fiasco, where Rush Card, the brand doesn't exist anymore. They got acquired by Green Dot, but their demographics, the customers are mostly African Americans, and for a week or maybe more than a week, for whatever reason, some kind of processing issues in the back end, the customers couldn't access their prepaid cards. They couldn't use the card, and even though the money is there, but they couldn't even have any bank inquiries. So as a result, they finally fixed the problem, but it was pretty big damage to their reputation, and they even got. I think they got sued, and they have settled a class action lawsuit. They also had to pay a hefty fine to the CFPB, and interestingly, not soon after that, another company went through the similar exercise or problem, which is very unpleasant, very similar issues, and but the company immediately set up a war room. They got the top, the president, the CEO, they all work there 24/7, and they kept the regulators actually informed, up to date of how many complaints they got so far, how many people still have no access to the balances, and what their plan is to fix the problem. And lucky for them, they got everything under control within a couple of days. But I think the proactive outreach to regulators definitely helped them avoid any kind of very negative and embarrassing public enforcement actions from the regulators. But at the same time, they learn a lesson from others, and it's really all hands on deck. It's, as Kristin said, it's not just the customer support, it's the top echelon of the company directly involved, and that actually set a good example, and to put a lot of pressure and to put all the resources behind that problem, and hence that problem can be solved very, very quickly and satisfactorily at the end.
Michael, as the fintech, is there a fear or a halo effect in some ways of Robinhood or some other big fintech that would have an issue that would then cascade down to a Novo, and do you feel that in terms of either your end customers or potentially future investors, stuff like that?
Yeah. So I'm going to answer this in a little bit of a different way, right? I'm going to kind of flip the question back. So the Robinhood effect, let's just play that in the banking 1.0 world. If Wells Fargo had a big thing come out where they were doing something poorly, which may or may not have happened recently, would that negatively impact some of the others in the industry? The answer is possibly for about 30 seconds, but then probably not, right? Will Wells Fargo get fined? Sure. Will Wells Fargo necessarily care? No, because it's all pennies at the end of the day for Wells Fargo, right? And so hopefully they correct kind of those actions and do right by the customer in the future, but largely it's kind of a blip on the radar. Now, when you pivot that over and talk more specifically about fintech, right? When you think about the overall goal of fintech, whether it's Robinhood, whether it's challenger banking like Novo, Chime, et cetera, or any other kind of application, right? The kind of goal here is the war against larger incumbents, right? It's the war against larger incumbents. How do we provide the best value and service to our customers so they don't continue to get disenfranchised by other players? And so with that in mind, and you then look at Robinhood, this specific Robinhood story, and I tried looking it up here, but I wasn't able to find it. But Robinhood's growth is absolutely bonkers at this year specifically. They grew at a clip that was absolutely crazy. I think they had somewhere a little over 10 million customers historically by the end of last year. And then they netted They literally increase in the first 2 months of the year by like 50 or 60% of their entire user base, right? Like that's literally monumental. So what does that mean? Like that's hugely beneficial for the fintech industry, right? That means adoption is surging through the roof. Last year, as a result of COVID, everyone is now looking for these kind of fintech alternatives because of that better service or product offering, right, that they're extending to customers, because of the, let's just say on average, more transparency. Sure, there might be some outliers there that might not be doing the right thing. Let's just say on average, there's more transparency in fees and the way that people do business and how they make money. And so when you see kind of that massive movement in Robinhood adoption, it continues driving the agenda that, hey, yes, people are willing to kind of go to that next evolution of fintech as opposed to big banks. Now, more specifically about this question itself, right? Like, do we have to work harder to make up for the shortcomings of others? Perhaps it's because we haven't necessarily been faced with it. There have been other, fintechs or challenger banks who experience certain kind of difficulties there. But I wouldn't say that we necessarily had to work harder to make up for it, right? Because if you think about it differently, like at Nova, we don't really consider any other challenger bank a direct competitor at all. Why? Because at the end of the day, all of the challenger banks or all of the fintechs, right, are effectively just picking up the crumbs left off of the plates of large incumbents. Right. So like they own 99% of the market. And so like at the end of the day, that is really the only big player that really matters when considering kind of our efforts and our product and what we do and how we acquire customers. So I know it's a little bit of a long-winded answer, but I don't think there are as kind of serious ramifications associated with that.
We have just a couple minutes left. I don't know if there's any other final questions from the audience, but I did want to go to you all for some final thoughts. Kristin, I'll start with you, just on the topic of trust and building trust and continuing that trust for fintechs, which is obviously a growing industry and one that's continuing to evolve.
Thanks, Todd. The couple of things I think I'll leave everyone with today. When we talk about trust, obviously, I think as we've shown, it can mean a lot of different things. The two things that I always kind of anchor back on as being helpful to remember. So, we're in a market now where after one bad customer experience, about half of users will leave a brand. This is across all markets. And after two, that percentage goes to 60, 70%, and in other markets, even higher. So, it is critical to think about the way that, not in these big lofty ways, thinking about trust, but also very practically, like every time your customer reaches out to you, are you giving them what they need? Are you doing it quickly? Are you doing it responsibly? These are the things that address retention challenges going forward, which are very expensive because we all know that it costs a lot to acquire users, and keeping them is the best way to revenue growth in the future. The other side of building trust is, that's the opportunity then to earn your way into a user's life even more, selling them more products, managing more of their money, whatever the case may be. It's off of that baseline that you're able to expand your relationship with those customers that you've brought in. And so while I think a lot of what we talked about was kind of how you repair and the negative sides and what you need to avoid, like there's a huge silver lining to doing this well as well, which is driving more revenue growth, driving more product growth in the base that you have, and getting those folks excited. I think Michael mentioned it earlier, Net Promoter Score, like getting those people excited to tell their friends, family, colleagues about your service and bringing those users to you. So lots to be done here, of course. If anybody ever wants to talk about the tools that can help you do it, that's what we're here to help with at Zendesk. But I just want to say thanks for having me as a part of the conversation today. Todd, Dan, Michael. Really enjoyed it.
And we're going to have to leave it there. Thank you, Kristin. Thank you to Michael. Thank you to Dan. Special thank you again to Zendesk. And if anyone hasn't seen it yet, the topic of trust, and we did a paper with Zendesk. Both Michael, Dan, and many others contributed to that. We'll make sure to link to it when we send the video out after the fact tomorrow. But it's a big topic, and so we greatly appreciate you spending a few minutes with us today. Thanks again to our panel, and everyone, enjoy the rest of your day and come back soon.
Thank you.
Thank you, everybody. Take care.
Bye-bye.